This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade Forex Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here, wrapping up the week. It is Friday, February 8th, 2008. Well, the dollar had an outstanding week. Despite growing speculation, the U.S. will enter a recession at some point this year. Data was hardly supportive of a strong dollar, with a decline in the services ISM index to just 41.9. Other pessimistic reports included weekly jobless claims at 356,000 and another drop in pending home sales. Stocks were not as fortunate, of course, taking big hits throughout the week. The Dow lost more than 600 points, and other major indexes are doing just as poorly. Carry trades mirrored the plunge in stock prices early on this week, but managed to decouple in the final 48 hours. We are not sure whether we can expect the correlation to return, and we'll keep an eye on this next week. Other news and events this week included interest rate decisions from the European Central Bank and the Bank of England. The BOE cut rates yesterday by 25 basis points as expected, bringing rates down to 5.25%. The bank's statement showed concerns over growth and inflation, which means the bank will likely move slowly if further cuts are in the cards. The ECB held steady again, leaving rates at 4%. However, there was a change in the tone of ECB Chief Trichet when he had his normal press conference after the decision. He said it appears as though the Eurozone may face greater difficulties than previously thought as a result of a U.S. slowdown and tight credit conditions. Traders now believe it is only a matter of time before the ECB is forced to cut rates in response to slowing growth. The euro and the pound have both shown a great deal of weakness, while other currencies such as the Aussie, Kiwi, and CAD continue to hold up very well on strong data and interest rate expectations. Now to the big picture. As today's date is considered to be the birthday of the subprime mess, it seems appropriate to at least touch on the subject. We know that what started as a meltdown in mortgage-backed securities has now spread through credit markets, and some experts believe the contagion could persist. Despite aggressive Fed rate cuts, it appears as though lending institutions are still unwilling to grant loans to many individuals and businesses. Traders on the floor have been quoted as saying, "The Fed has made money cheap, but it's still unavailable. If people can't get loans, it really doesn't matter what rates are attached to them. Until they figure out how to get the banks lending again, the real estate market will almost certainly remain weak, and the U.S. economy faces a possible recession." The good news is that the government tax relief plan is moving right along, and checks could be in the hands of consumers by the end of spring. Of course, it seems that it will really add very little growth and is more wasted government spending. This weekend's G7 meeting in Tokyo could yield some good news if central bank officials can collectively put together a global game plan to get credit markets back on track. However, we've already heard comments from the German finance minister that problems began in the U.S. and we need to fix it. So, we go into the weekend with our fingers crossed that other attendees will not be so thick-headed. If something doesn't happen quickly, the global economy is at risk and no currency is immune, not even the euro. Till next week, have a wonderful weekend. Take care.